Hi, and welcome back to Channel 11. I'm your host, Ken Shinoda. Today is Thursday, June 7th, and we're going to review May. Where is the recession is the title of this month's episode. Let's look at stocks, equity performance. Really strong on the NASDAQ, now up 24%, the big loser of last year, the big winner of this year. S&P up almost 10, defying what many people expected for this year, the year of the recession that hasn't come yet. Nikkei also up big, up almost 20%. In fact, the Nikkei is now at a 33-year high. It's been a long and winding road, but the Nikkei has really been ripping since kind of the early 2010s, almost back to that high that we saw in the late 80s. Looking across sectors in the S&P and factors, again, it's been this big story of growth. There's like 7 stocks in the S&P driving everything. You can see that on the left-hand side, consumer discretionary, information technology, consumer services really driving returns. It's all that mega cap tech, the AI trade that's been bringing the stock market up. Many sectors negative on the year, especially last month. You can see some big drawdowns in energy and consumer staples. We talked about sell in May, go away last episode, and unless you were in tech and the Nikkei, it worked. Many parts of the financial markets having negative returns, fixed income, you see global equities on the far right-hand side, commodities very weak as well. So sell in May so far has been working. We have had a rebound rally thus far in June. Looking at the dollar, also having a little sell-off this year. It's hard to get too negative on the dollar in the near term. I think that if you do see kind of a risk-off trend, that there will be flight to quality in the near term of the dollar. But we still are bearish dollar long-term given high deficits in the US. But in the near term, I think it's hard to short the dollar here. Here on the right-hand side, you can see the weakness in commodities. Basically, in the commodity complex, everything's down but gold. Gold's been kind of the one place where we've seen some strength in the commodities market. Looking at the dollar, the near-term movements have, I think, really been driven by policy. Here you can see the 2-year Treasury yield in red, the dollar in blue, and with the changing expectations of Fed hiking or not hiking, or the changes in the terminal rate, the dollar's kind of been moving with that. So I think in the near term, it's a lot of global policy, the differences between where the Fed's going to take our policy rates versus other global currencies, the euro being the biggest component in the Dixie index. So that's going to be driving some of this movement here. Treasury yields. Talked about this last episode. We think that the 10-year peaked last year. You can see this trend line on the right-hand side here on the 10-year. We got up to around intraday 430 in October of last year. We had another sell-off in late Feb, early March before the rally that was sparked by the SVB incident or bankruptcy. And if you draw a trend line from those two peaks, you get a trend line support around 390. So I think somewhere between kind of this like 370 level and 390 is a decent buy zone. We've been talking about that for the last couple of months. Don't get too cute. If you get these backups, we don't think you will see much higher than 4%. So we're playing for the long run here. We're playing for that slowdown that we think is going to come, and we think we'll make money on long-term rates. The 2-year we think peaked right before SVB. We saw that sharp rally, and now we're kind of back to levels we saw at the almost the beginning of the year. So rates are a little bit lower on the long end of the curve, but they're kind of back to where they were at the beginning of the year on the front end of the curve. So again, we think these rates have peaked and are coming down. So you really haven't missed much. A lot of people maybe feel like they missed the opportunity in fixed income. Here we see on the left-hand side the traditional parts of fixed income, Treasury, agency mortgages, IG. IG yields basically about the same as the end of the year, end of last year. Agency mortgage yields are actually up because spreads have widened on agency mortgages. And here on the right-hand side, you can see the non-traditional parts of the market, high yield, bank loans, EM. Yields are down a little bit, but they're pretty much kind of where they were. CMBS being the outlier that's up a lot because of some of the concerns around office space. We'll dig deeper into the CMBS market later, but you haven't missed it. It's really been a story of carry. The traditional parts of the market yield roughly 4 to 5%. We've seen we're almost through half the year, so we're just kind of clipping the carry in most of these sectors. Again, CMBS sticking out, slight negative return for the BBB part of those capital structures, but basically positive returns across fixed income, largely driven by the coupon that you're earning. So rates haven't really moved around that much. Spreads have kind of come in a little bit, but you're just clipping that carry in fixed income. I know everyone was expecting, some huge reversal in rates, but good old-fashioned way to earn money in bonds is just clipping that carry, and the carry is very high right now. Terminal rate, this is Fed funds terminal rate. We had that big collapse after SVB. We've been slowly climbing back up as risk assets have been doing well. Economic data was coming in stronger. You're starting to see a little bit more weakness. Services PMI came in weaker. So we'll look at some of that data later. On the right-hand side here, you can see the market implied Fed funds rate. A month ago, it was lower, and we thought the Fed wouldn't hike again. This was kind of right after the bank turmoil. You had First Republic go down as well. And as time has passed, and at least the market feels a little bit better about risk assets and maybe that the recession's pushed out. We also have, inflation not coming down as fast as it was. And so the market has shifted back up to, maybe a pause this next time and then a hike in the following meeting. But you can see that movement up in the implied Fed funds rate through time, which is also why the broader bond market has backed up in yield off the kind of lows that we saw, the 10-year going down to that 330 level. Inflation expectations still remain relatively anchored. This is looking at break-evens, which is the rate of inflation implied by the TIPS market. And you can see that spike in the blue, which was the 2-year towards the beginning of the year, and that's come down. So this is kind of net positive for the market, that inflation expectations are anchored. And that's, I think, one of the reasons that we talked about last month that risk assets, especially stocks, have been doing. Okay, so where is the recession that we've all been waiting for, that everyone has been forecasting? And you can see this, we actually got this from AI. We're starting to dabble around, and I think we put in like cloudy skies recession or something like that, and this is what came up. And everyone's looking out for it. And where is it? Well, there's a couple of reasons I think that it hasn't come as quickly. This is fiscal spending growth following the onset of recessions. And 2020 with the pandemic was just, something we haven't seen in a very long time, maybe ever, as a percentage of GDP, at least going back to 1970. So there was a lot of fiscal stimulus pumped into the system. I think some of that money is still out there, and it's extending out when that recession may hit, right? This is looking at recessions through time in the shaded line. This is from Deutsche Bank, that big fan of Jim Reid and their team. And you can see that the blue line is showing you deficits, right? So we're spending money to help stop recessions or spur growth. And back in the day, call it like pre-World War II, rarely did we see such dramatic deficit spending outside of the Great Depression, Civil War, World War I, World War II. And you can see that the space between recessions was much tighter, right? And as time passes, you kind of get into the post-World War II era where deficit spending becomes more popular from a policy standpoint. The time between recessions has increased, right? And maybe some of it's also because of technology or, other economic reasons, but there seems to be a pretty decent theme here. And look at the far right near COVID. We are seeing these huge deficit spending programs. And so again, I think this is one of the reasons that we've seen the time between recessions continue to extend. The consumer got a lot of stimulus checks, right? And they had a big buildup in savings, almost $2 trillion. and they've been using that savings, and I think that's helped keep retail sales up. 2/3 of the economy is consumer spending, and this is Deutsche Bank's forecast that they're spending it, they're going through it, but by the end of the year, it's going to be gone. And so this for now has helped keep, I think, the economy afloat, but based upon this forecast, the money is going to run out, that excess savings is going to run out towards the end of the year, which that's Deutsche Bank's recession call. It's the end of the year. They said, have to push that out towards beginning of 2024. But there's still a lot of signs that say it's coming and the economy is slowing down. So here you see that manufacturing PMIs already in the negative. You had that pop up in services, which is starting to come down again. So this is not quite negative yet, negative territory being below 50, but it's almost there. So the trend has definitely been a slowdown. These are charts Jeffrey just used on his webcast yesterday. I put them in here before I knew he was going to use them, but we'll go through them together ourselves. This shows you different economic indicators leading up to a recession. So 2 years prior, 2 years after the recession being the black line that's vertical. And this goes back through 1968 and shows you the 25th to 75th percentile. You can see the average of this data point, which is leading economic indicators, which we've looked at the last couple episodes. The average being in the red dots, the median being in the yellow, and where we are today. So we are way below historical trend of where this indicator is by the time you're in the recession. But we started at a much elevated point. You can see the black line in the far left was way higher than relative to history, and I think that has to do with that fiscal stimulus, that deficit spending, the stimulus checks and things like that we saw. So we had this big pile of money pushed into the economy, which helped drive spending, and that's why LEI was so elevated. So being so high, it's not surprising that it's fallen so much. But I think, you got to respect some of this data. PMIs leading into a recession were also elevated at the very beginning, going back 2 years, for the same reasons, I think. And now that's kind of below trend, but right about average as you hit the recession, slightly below 50, usually troughing a couple months after you're in the recession. So this sign shows you're close based on PMI. ISM New Orders, same story. Maybe this is even worse than average. I think this also has to do with the fact that a lot of manufacturing was front-loaded by the demand for goods, right? There was this big kind of like front-loaded demand for goods during the pandemic that shifted to services. So maybe not surprising again that we see the same theme, starting higher, ending lower in some of these metrics. So, these are recession watch signals. Recession doesn't mean the end of the world. Earnings roll over, stocks may go down, bond yields may fall. So, we don't. I try not to be so dramatic about it, but as an investor, you got to think about positioning. So, if we're going to go into recession, you want to own some longer duration bonds. You want to maybe underweight certain parts of the risk markets. Commodities going into recession, they already haven't been performing well. They probably won't perform well in that environment too. One of the things that got us more bared up, which we talked about in the Turning Bearish episode, which seemed to get a lot of hits. Seems like everyone out there likes negative headlines. So I figure I got to use some more negative titles for these episodes to get more hits. But this shows you the bank lending standards and also demand for loans. I mean, it's kind of like a two-way street as far as the way the banking system works. Banks may not want to lend out money. That's negative. But at the same time, even if banks wanted to lend out money, do the end users, small business, for example, do they want to borrow money? And you're seeing both happen because of kind of the banking issues and the deposit flight. Banks don't want to lend. At the same time, as borrowers don't want to borrow. Rates are high. And everyone says there's a recession coming. So if you're a small business, are you really going to expand your business today? Are you really going to go out and hire? Are you going to open another restaurant? Are you going to open another laundromat? And if you look at small business CapEx plans, it's kind of a survey. It's been going down. It's not really surprising. If I owned a small business, I probably wouldn't be thinking about expanding right now, given everything that's going on out there, given how high rates are. And rates are super high. This is the interest on short-term loans. So if you're a small business and you want to borrow money, that's 8%. I mean, so you got to earn more than 8% your cost of capital to make borrowing that money profitable. So this is, the Fed is kind of getting what they want. They raise rates, borrowing costs have gone up. Eventually, the spending and as far as businesses investing will go down. It just takes time. And I think it's hitting small business now. Small business is 46% of employment in the US. So eventually we will get the slowdown that the Fed is looking for. Here are hiring plans. They're still pretty elevated, but the trend is down. And you can see that when it drops pretty rapidly, right? So much lower during periods of recession. So this kind of tells me, we're not quite there yet, but and you can see this if you look at job openings and things like that. And we had the jobs report with over 300,000 jobs created. But again, I think this is really important. We got to watch this, and it seems like the trend is kind of rolled over, and this points to the slowdown continuing. All right. Well, what looks cheap? A lot of these sectors that look cheap have been in the what looks cheap area for a while. Agency mortgages and AAA CMBS on the top left. The further up you are on this chart, the cheaper you are relative to your own spread history. And agency mortgages off the charts. This is as of May 31st, 100th percentile. Basically, over the last 10 years, it's never been cheaper. It got all the way up to about 190 spread last week. It's rallied back a little bit, kind of to this 177 area. So very compelling, high quality asset. You get a lot of yield over treasuries. You're a government guaranteed bond. You have low volatility relative to other parts of fixed income. It's a really good defensive play, and like they say, sometimes a good offense is a good defense. So I think agency mortgages are one of our highest conviction ideas there. AAA rated CMBS also looks really compelling. It's baby out with the bathwater type situation where everyone's worried about office space. A lot of bonds are not 100% office. There could be a little bit of office in there, but we'll take a look at CMBS a little bit later. A lot of parts of the securitized markets, and we've talked about this a lot, stick out. IG and high yield on the richer end. Not as rich as they were, let's say, at the end of February. They both got down to about kind of sub 50th percentile. IG sold off first, got all the way back up to about 80th percentile. We've seen a little bit of a rally, so it's come back in since then. High yield was looking rich to IG, and that's kind of cheapened up a little bit too. So a little bit more fair value in some of these assets. Again, as we looked at earlier, you haven't really missed much in fixed income. Yields are basically almost where they were at the beginning of the year. It's been a year of clipping the carry, and I think there's still opportunities out there to add, especially high quality fixed income on the shorter end of the curve, where you can find investment grade bonds that are yielding 6-7%. Just seems really good time to kind of lock those yields in case the Fed ever cuts and the gift of the T-bill is gone. Sometimes people say, hey, you're trying to hide something from me. Why only go back 10 years? Well, 10 years is a nice round number. Also, some of those indices on the other page didn't exist. So this is through the GFC. What about the GFC slide? And you can see agency mortgages on this metric still in the top decile, 94th percentile. Credit will look worse on this because credit got really wide during the GFC. So this puts IG and high yield mid 50th percentile, but agency mortgages and AAA CMBS 75th percentile still looking pretty cheap. Look, bank loans look cheap for a reason. There's risk out there. The cost of debt has gone up a lot with the floating coupons going up. And the market's pricing that in efficiently. We can see on this page that look at where high yield is down here, 70th percentile, bank loans up there, north of 95th percentile. So I think the market's pricing that risk in. Agency mortgages, another look. This is looking at the spread. Basically, 2 standard deviations plus over the last, going back through 2009. So we're basically got the spread levels we haven't seen since the global financial crisis. And the risk as measured by convexity or prepayment risk is really low. It actually could be slightly positive right now because everyone's in these super low coupon 3.5% mortgages, and mortgage rates are 7%. So nobody is going to refi, at least for the first 100 basis points in the market. What is it going to take for those spreads to come in? Well, there's the headwinds that the mortgage market faces. You've got the quantitative tightening. The Fed's not buying anymore. You've got the banks on the sidelines because they're losing deposits. You've got sales coming from the FDIC, from the Silicon Valley Bank portfolio, about $100 billion of mortgage bonds needs to be sold. And rate volatility is high because of uncertainty around central bank policy. So here you can see the agency mortgage current coupon spread marching higher in 2023, all the way to that kind of 190 level that we saw. And in the gray bar, this is swaption volatility. So it's a metric of rate volatility that the mortgage market looks at. And they're usually pretty correlated. Look at that R squared, 0.79. And now you see this alligator jaws that's been created, this divergence. So either the mortgage spread needs to tighten or interest rate vol needs to come back up. And so we think that when you get to the point where the market is more convinced towards the end of the hiking cycle, rate vol stays lower, and then you get through the supply from the FDIC, that people are seeing the relative value now. We're seeing money managers step in. We saw a lot of support of buying come in at that kind of 190 level. And so through time, you will realize this value. You will harvest the value in agency mortgages. It's not going to happen overnight, but through time, this relationship should normalize. If you were a hedge fund, you could go long the basis and long swaption volatility right now as a pair trade, saying that if spreads don't come in, then swaption vol should pick up. So that can almost kind of act as a hedge, assuming that relationship will normalize. Another interesting divergence is the difference between rate volatility as measured by the MOVE index in the gray and the VIX index for stocks. VIX actually just hit 14 handle, which is the lowest that it's been since February of 2020, right before the pandemic. So if you've been thinking about buying protection, now is probably not a bad time. A lot of complacency in the market, stocks making a new high. Rate volatility, however, looks a little bit more on the expensive side. So I've seen some people talking about a trade where you short rate vol and you go long equity vol, hoping those things converge, or using one as a hedge to the other. So far hasn't been working because stock vol's come down and rate vol has remained elevated. But again, at some point in time, these will probably converge. It's kind of similar to that agency mortgage basis and swaption vol that we looked at earlier. Digging a little deeper in CMBS, looking across the capital structure, on the left-hand side, you can see spreads, that big gap up in the BBB spreads, and on the left-hand side, that top line. And on the right-hand side is kind of historical range of spread over the last 10 years. The average spread in the blue, the diamond being, or I guess the triangle being today. You can see we're way above average. We're not at the absolute wides, but those absolute wides aren't there for, a long period of time. That's why we look at percentile rank. So on a percentile rank, based on trading days, we're, 96th through 97th percentile for the investment grade portion of the market, 100th percentile for BBBs. For a reason, that's kind of the fulcrum tranche, we call it. That's where it starts getting binary and a couple lumpy loans go down, you can get hit. So I think that's why the market is so wide there. But single A and up, pretty robust protections, and it would be really hard to take losses. So investment grade CMBS, super cheap, and something to think about right now. It's already pricing in basically recession risk at some of these spread levels. I mean, you got single A's at 600 over, with the risk-free rate kind of around 4, the belly of the curve. So you can buy 10 yielding bonds, single A rated. Another thing to think about is all-in price. A lot of investors obsess over spread. People say, oh, I want to buy high yield at a spread of 800. Well, when the risk-free rate was 0, that was a yield of 8. Today, the risk-free rate is much higher. And so we may not be at the spread levels, for example, seen during the dark days of March of 2020 and the pandemic. You can see that big sell-off where you got some bonds down in 65 cents on the dollar. But look at the single A in that beige color in the middle, right? We're actually below that on a dollar price basis, because while the spreads were not as wide as they were during those dark days of March 2020, the all-in yield is higher because the risk-free rate is much, much higher. And so that now puts these dollar prices way lower than they've been in a very long time. So spread is important, but also think about that dollar price. And the reason I say that is you could be in an environment where spreads are widening, but there's a lot of room for, especially the front end of the curve, to fall. So yeah, your spread could be wider, 200 basis points on a 2-year credit bond. But if spreads are wider by 200 basis points, I think the Fed's cutting, and so short-term rates will be falling. And so you're going to have some protection there, especially in fixed-rate bonds. Now, yes, there's a lot of headline risk around commercial real estate, but the quality of underwriting has been improving since the GFC. This is loan to value or leverage in the different parts of the market, and you can see that the loan to values for both broad commercial assets and apartments have been coming down as the market has been becoming more conservative, much, much lower than we were during the pre-GFC era up in the 70s. This is another look at how things have changed through time. We call the old bonds, the ones that were made pre-global financial crisis, CMBS 1.0, and we call the new bonds that were made after the GFC 2.0, post-global financial crisis. And these are different metrics that we look at when we're looking at bonds. On the top left, loan to value. How much money did the borrower put down? Pre-GFC, 70% average loan to value. Now, 52%. That's way lower risk. That's a lot more equity. That's a lot more cushion until your loan will start seeing losses. Debt service coverage ratio, how much cash flow is coming in from the properties to cover the debt. On average, used to be 1.4. Now it's almost doubled to 2.6. And then debt yield used to be 8.9, now 11.5. It's basically the cap rate, where cap rate would need to be on a property and be sold for you to take first dollar loss on your debt, is the way to think about that debt yield. So that's a pretty high debt yield now. Below this is what we call credit enhancement. This is the percentage of bonds below you that needs to get totally wiped out till you get hit. AAAs, 30%, still about the same as it was pre-GFC, but for junior AAAs, for AAs, for single A's, you basically need 2 times more credit enhancement or safety to get the same rating today. And so that means that the bonds are more secure from a structural standpoint because of that credit enhancement, and then the underlying collateral is actually much safer too. So we think that with today's credit enhancement levels, it is very unlikely, even with the problems in office, to get hit when you're at the top of the capital structure in these investment grade bonds. You still have to be selective. You still need to underwrite the properties, and that's what we do. We go into these transactions and we underwrite each of those properties, and we try to basically see which assets we think will pay off. And it's if we have enough assets that if they pay off, we'll get paid back on our bond, we're good. This shows you losses historically. 08 looks like the worst. This is a small sample set. In 08, it's like a bunch of loans left on bank balance sheet that were packaged up and sold. It's probably kind of the worst loans out there. The loan count is smaller on 08 vintage. 07 was kind of still a normal market, so I think that's more representative of historical losses. And the underwriting collateral was worse then. So you've seen since GFC, we've had pretty low losses. Granted, we haven't had a bad recession. We kept getting bailed out by the Fed, low rates. So losses will pick up. But again, we think that you could see pretty draconian losses similar to the global financial crisis, if not worse, and you would still not get hit in the investment grade portions of these markets, especially at the AAA level. It's a very, very remote chance for losses. Last but not least, the CAPE ratios that we talk about, basically looking at the cheapest part of the markets and on a cyclically adjusted basis using the CAPE ratio. We have a couple strategies that incorporate this. And the bottom 5 are what we look at. And you can see that for the US, that is materials, discretionary, financials, real estate, communication services. And what the strategy does is it throws out the value trap or the sector that has the worst momentum, which, not surprisingly, has been real estate in the US. And this is as of the beginning of April, what that strategy owned. And looking at Europe, we can see that it is staples, comp services, materials, discretionary financials, and real estate. And it's throwing materials out that has the worst momentum. So that's it for this episode. Wanted to talk about things that we're seeing as far as recessionary signals out there. There's continued slowing in the economy. Bonds are still looking interesting. You didn't miss it. The T-bill looks great, but the T-bill will go away one day, when and if the Fed cuts. And so take a look at those bonds out there. We still think there's a lot of value, especially in that mortgage space where spreads are near historical wides. So thanks. Good luck out there, and everyone start to have a great summer.